Welcome back to the Neuro Finance Masterclass. Today, on day 106, we look at the ultimate truth serum of corporate earnings. I'm Ibrahim, and I'm absolutely thrilled to be here with my co-host Elena to guide you through today's explainer. We're putting a massive magnifying glass on the real core engine of any business, operating profit and EBITDA. We're going to show you exactly how to look right past the smoke and mirrors of traditional accounting.
That is exactly right, Ibrahim. And look, we're coming in hot today with some seriously high energy because we need to shatter a massive misconception right out of the gate. Net profit? It's a dangerous illusion. When you rely on the easily manipulated bottom line, you're just not getting the full, authentic story of a company's health. You're getting the story the financial engineers want you to see, and honestly, falling for that can cost you dearly.
Okay, let's dive into this syllabus. First up, the net profit trap. Then, we'll uncover operating profit and decode EBITDA. After that, we'll apply the EBITDA margin filter and finish up with the operational audit so you walk away with the exact tools you need.
Section 1. The net profit trap, or what I like to call the illusion of the bottom line. Yesterday, we analyzed macro risk, but today, we're stepping right into the corporate boardroom to expose a massive trap.
Think about the stark difference between how an amateur and an architect view the world. When a naive retail investor opens a financial report, their eyes start straight to the bottom line, right? Net profit, or what we call net donem chiara in the local markets. If that final number is huge, they blindly hit the buy button. But the architect, we see right through that facade. We immediately spot the hidden financial distortions. We look at that exact same bottom line, but we see the local taxes, the varying interest rates, the arbitrary depreciation rules, and worst of all, the non-operating income padding the numbers.
Moving on to Section 2, Uncovering Operating Profit, also known as SS Filiat Kara. This metric tracks only the raw revenue generated strictly from a company's core operations, stripping away all that peripheral noise.
Let me paint a vivid picture for you to show why this distinction is literally life or death for an investor. Picture a dying textile company. Its factories are completely empty and its daily sales have absolutely collapsed. However, decades ago, they happened to buy a prime piece of real estate right in the city center. Out of sheer desperation, they sell that land for a massive $50 million. Suddenly, boom, their net profit absolutely explodes. The amateur sees this massive spike and thinks, wow, this company is a revitalized gold mine. But the architect looks slightly higher on the statement at the operating profit line and sees a glaring, massive negative number.
And this brilliantly illustrates our whole point. Despite that massive $50 million cash influx just sitting there on the bottom line, the negative operating profit proves that the actual core engine of this business is totally dead. They aren't innovating, they aren't producing anything, they are, quite literally, just selling off the furniture to stay alive for one more quarter.
Section 3. Decoding EBITDA. If you want to elevate your quantitative neurofitness, this right here is the holy grail. It's the ultimate tool used by international hedge funds for cross-border valuation.
So let's break down this famous acronym, EBITDA, which is known locally as FAVÖK FAVÖK Ongeskär. Why do the biggest institutions on the planet look at this instead of net profit? Well, because interest rates, tax laws, and depreciation accounting rules vary wildly across different countries and regions. EBITDA strips away all of those external, geographic, and financial distortions. It measures the raw, unadulterated cash-generating power of the business model itself.
Let's move to and see how this builds mathematically. It's actually a highly logical progression. Step 1, you start with that operating profit we just defined. Step 2, you add back depreciation. Remember, that's just an accounting measure for wear and tear, not an actual cash outflow. Step 3, you add back amortization, which is the write-down of intangible assets. And finally, Step 4, you arrive at your pure EBITDA. This formula reveals exactly how much juice the corporate machine can squeeze out, completely independent of how the company happens to be financed or taxed.
Which brings us to Section 4, the EBITDA margin filter. As an architect, you're going to use this margin as a weapon to ruthlessly compare competitors, tying right back to our sector dominance lessons from day 103.
The math here is simple, but it is incredibly powerful. To find the EBITDA margin, you just take your calculated EBITDA, divide it by the total revenue, and multiply it by 100 to get a clean percentage. This formula establishes the true baseline. It's exactly how we measure the operational slackers versus the absolute powerhouses in any given industry. Now, what's really interesting about this slide is comparing two competitors. Let's call them Company A and Company B. Both generate exactly $100 million in total revenue. If you only looked at sales, well, they look like equals. But let's compare their margins. Company A has an EBITDA margin of 25%, while Company B is struggling at just 8%. This vividly demonstrates a massive performance gap between two companies with identical revenue streams.
Let's analyze why that is. Company A, sitting pretty at a 25% margin, is an absolute powerhouse. They possess structural pricing power, highly efficient supply chains, and a massive competitive moat. They literally dictate terms to the market. But Company B, at 8%, they're a slacker. They're highly vulnerable to inflation shocks. If you recall our lesson from day 87, if input costs suddenly spike, Company B gets wiped out instantly. Meanwhile, Company A comfortably absorbs the hit.
All right, Section 5, the operational audit. It's time to shift gears from being a passive learner to an active architect.
So, the crucial point is how you actually apply this. Follow these 5 steps to audit your own portfolio and expose any artificially inflated earnings. Step 1. Pick a prominent company from your watch list. Step 2. Open its income statement or GL tableau. Step 3. Side by side, compare the net profit against the operating profit. Step 4. Calculate or locate its EBITDA over the last 4 quarters. And Step 5. Check if the core operating profit is organically growing in tandem with the net profit, or if those earnings are just a facade pumped up by one-off side operations.
It's really time to train your mind to completely ignore those superficial headlines on financial news networks. Stop buying into the glossy corporate presentations. We're going to leave you with this final, provocative thought. When you allocate your hard-earned capital, are you buying a flimsy corporate facade, or are you buying an unstoppable core engine? Audit the core, measure the raw power, and rule the cycle. We'll see you in the next explainer.